How much more is Meta stock going to fall? I'll tell you what, if you're an investor of Meta, that's definitely what you're thinking after year to date being down just shy of 50% and reporting weak guidance. We are surprisingly seeing a slight pop in the stock here after hours. We'll talk about where we think this stock will be going from these levels now that we're at a price to sales ratio of about 4 and a price to free cash flow ratio of about 11, making this the cheapest out of the FAANG stocks. So we'll talk about this from a value investing perspective. But first, how's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we're going to talk about Meta's Q2 earnings results as we're coming off the back of a weak Q1 that definitely disappointed Wall Street. We'll also go through the numbers, the top line, the bottom line, the weak guidance that they've just reported, as things seem to be potentially getting worse for Meta here. And we'll finally conclude with an evaluation of this business using our intrinsic value calculator to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we'll be doing this video and this analysis within 5 minutes. So let's jump into it. So Meta, formerly known as Facebook, they're planning on taking over in the metaverse space here, and they're trying to be a big conglomerate in this space. And well, that is what they plan to do. How does it actually translate in the fundamentals? And as you can see, year over year, quarter over quarter, we have been experiencing growth. However, starting in Q1 of 2022, we've actually seen quite a significant decrease, and especially in the US and Canada, which is not good for their business. And then the same thing, we've only seen a very slight uptick from Q1 2022 into Q2 2022. Now, why is this bad? Let me show you actually their expenses as a percentage of revenue. As you can see, typically when we look at their revenues in Q1, they will have a slow Q1 and then it'll progressively get better, right? We'll also see a decline typically in their expenses. However, this Q1 of 2022 and Q2, we've seen a significant decline. In fact, their cost of revenues, research and development that they've been spending in order to get Metaverse up off the ground because it's currently eating up cash flows, yeah, their expenses are increasing quite a bit and it's really eating into the revenues. And this is why it's been a disappointing Q1 and actually kind of now Q2 for Facebook or Metaverse. And as you can see here, while we were increasing from Q2 2020 all the way up to Q4, now since then we've actually been declining in net income in the bottom line here, and now we're down to about $6.6 billion in profits, where we used to be at 10 and even up to 11. So significant decline here. The expenses are eating up a lot of the revenues, and this is the reason why the stock is down 50% year over year, especially since this is a growth stock. This is what happens. And again, the same thing you'll see with the diluted earnings per share figures. So looking at our income statement here, we have revenues of 28 billion, which we just discussed. Let's call it 29. Then cost of that revenue come in at $20 billion. So we're left with $8 billion for income from operations, deduct for taxes and such, and we're left with $6.6 billion in net income here. 2.46 in earnings per share. So we'll keep that figure in mind. And actually for the first 6 months of 2022, $5. So we can extrapolate that it'll probably be $10 in earnings per share. We'll use that figure for our calculation. Now onto the balance sheet here. We have about $12 billion in cash, $27 billion in marketable securities. So let's say altogether they have about $40 billion in cash. But when we're looking at the liabilities section here, we can actually see there actually isn't any debt figures here for us to report on. So they have about $40 billion in cash, but then no debt. So that is good. And that's why their shareholders' equity has been increasing year over year. Now onto the statement of cash flows here. And let's look at this from a 6 months perspective here. So for 2022, net income came in at about $14.1 billion. We add back in depreciation, amortization, stock-based comp, etc., etc. We're left with $26.2 billion in operating free cash flow. We deduct our $13 billion here for capex, and we're left with, let's say, $13 billion in free cash flows to reward shareholders. How does Meta reward their shareholders? Well, they repaid some taxes, that's fine. And the rest of it they paid to repurchase shares to reward shareholders. So again, they are trying to increase the value of these shares, which actually is a good thing to do at these current levels, especially when the stock price is suppressed. That's the best time to repurchase shares because this will really drive the stock price higher once we do effectively see a turnaround here. Now, jumping into our calculator here, Meta came in with about $5 for the first 6 months of the year. So of course, we're going to extrapolate that they can make at least $10 in earnings per share. For the rest of the year, we require a 10% return. They do not pay a dividend. They're reinvesting into the business. However, they're not growing at 15% year over year. Currently, they're actually down 1% year over year, especially in terms of the revenue growth. Down actually 36% in their bottom line. So this doesn't look good. But if we are to assume that Meta can get back to their growth metrics here, let's give them a 10% year-over-year growth rate for the first 5 years, and then say it can slow down to 5% on a 20 PE, this stock can be worth 166. Guys, the stock is currently worth 169. This is me being optimistic in this situation here. We'd be valued at a 10% return from these levels here. Now, in the best case scenario, let's say they can actually achieve 15%, especially once metaverse actually kicks off and everyone's using the platform. Let's say they can grow up 15% year over year and then 10% for the 5 years after that on a 25 PE. Yeah, we'd be at 312, so nice double almost. But in the worst case scenario where we continue to decline from these levels, let's say we actually start declining at 5% for the first 5 years, and then we can normalize out at 0% on a 15 PE, this stock would be worth 50 bucks. And this is the real issue with Meta here, and is the issue with all growth stocks really, is that once the growth slows, the stock will plummet, despite the fact that they're at a PE ratio of 12, which they historically, and if I actually pull this up here, historically their PE ratio, the last time that it was down at this level here was in 2019, and we actually saw in 2019, if I pull this up, we saw that we actually had a nice increase from that point. However, at that point in time as well, they were also growing on their bottom line, their top line. The issues at that time were around scandals and such within the business. This time it's a little bit different. The fundamentals have actually changed, and this is the issue with Meta. So for right now, I'm staying hands off. It seems a little too risky, and the growth has not changed. If the growth story does change, I might become interested, but until then, I'm staying away from this. That is my analysis on Meta's Q2 earnings. If you enjoyed the video, please give it a like, subscribe, and I'll catch you on the next one.